You're standing outside the Bay Hill Apartments, a sprawling complex in Florida with peeling paint, wavering tenants, and an unsure future. Jeffrey Fisher pulls out his notebook, scanning lease details and market stats as the sun blazes overhead. How do you assign a dollar value to this cash flow puzzle? What if you guessed wrong? Dive in with Fisher. This isn't just numbers. It's a living story of risk, opportunity, and crystal-clear valuation. Understanding where a property sits inside its market scene is the starting gun. Neighborhoods breathe, shift, and sometimes collide with harsh realities. How do you decode that pulse to set a price? When Fisher assessed Bay Hill, he didn't just eyeball the building. He dug into the neighborhood's story: rising crime waves, upcoming transit lines, and competing apartment complexes. These threads shaped the way tenants behaved and rents fluctuated, proving location isn't just a coordinate. It's a dynamic, living ecosystem that demands attention. Think of property appraisal like tuning a vintage guitar. If it's out of tune, too many assumptions or ignored factors, the value you play won't resonate. Fisher's approach uses market data like strings, tightening each one to hit perfect harmony between price and potential. Here's the kicker. Understanding market signals transforms you from an appraiser guessing blindly to an investor capitalizing on trends. That neighborhood with fading charm, it might hold hidden gems or redemption stories that flip the valuation upside down. What if you could see the property's lifeblood, its income, throbbing day by day? Fisher's cash flow forecasting isn't guesswork, it's math and intuition dancing together under pressure. Bay Hill's leases had staggered expiration dates and varying rents. Fisher modeled each carefully. By projecting rental income, vacancy risks, and expenses month by month, he built a cash flow mosaic that predicted future ebbs and surges, turning vague guesstimates into a living forecast. If compound interest feels like a magical mushroom, you're not alone. Fisher shows it's actually a relentless snowball rolling downhill, growth feeding on growth. This principle shapes discounting profit streams back to today's dollars, making future income tangible and reliable. Enough number crunching, now for the wow. Once you understand future cash flows and discount them with compound interest, the property's value isn't just a snapshot, it's a movie. You see the full investment arc, spotting opportunities others miss or risks they gloss over. You might have heard discount rates are just numbers wrong. They're your risk radar, a crystal ball for investment judgment. Fisher's deep dive makes you rethink every assumption. At Bay Hill, Fisher didn't just grab the market average discount rate. Instead, he tailored it, weighing the property's unique risks: local economy, tenant quality, financing structure. Discount rate became a lens, filtering out noise to reveal true investment worth. Mortgages aren't simple. Fisher explores leasehold interests and non-typical financing arrangements that can skew value. Like a chess player, understanding how each financial piece moves and captures ensures your placement optimizes returns with minimized surprises. Risk analysis here isn't gloomy forecasting but empowerment. When you quantify uncertainty, it's no longer a monster under the bed. It's a tool that boosts your confidence to say yes or no, investing with eyes wide open and wallets smarter. Back at Bay Hill, the sun's ready to set as Fisher packs up. That mix of crime stats, cash flows, and risk assessments now tells a clear story, whether to buy, hold, or walk away. Here's your takeaway. Next time you eyeball an investment, map out its cash flow and nail a tailored discount rate. That's where real valuation magic begins. Subscribe for more book summaries like this one.